Good morning and welcome back to another pre-market report. This is Edwin, and this channel is not a stock tip channel. It's aimed at helping investors understand what happened, why it happened, and how it could affect them. This is to educate investors rather than give them buying and selling tips. Let's dive right into it. Today's something that we'll have to look for, or the investors can look at, is the Federal Reserve's hawkish pivot. The Federal Reserve releases the minutes of its June policy meeting today, and the tone for that meeting was already described as hawkish, with the Federal chair reportedly stating that the prices are too high. Two forces that are combining here is the oil price ticked back up after the Hormuz incident. LNG vessel was struck by a projectile missile while transiting out of Strait of Hormuz, so that increased the price and reviving inflation concerns, just as it seemed like they were fading. Second, June's hawkish federal commentary suggested that the central bank sees underlying inflation as stickier than they would have hoped for. Even after the June softer June report, job report, and there could definitely be a rate hike. And why this affects the investors, or should the investor should have eye on this, is because once the US bond yield rises, US government debt becomes more attractive relative to riskier assets like emerging market equities, that is India and few other countries. So the foreign portfolio investors often relocate money out of market like ours and into US treasuries, which yield when the yield climbs, because when because they can get a safer dollar dominated return without taking any equity risk. And second is state of Hormuz incident tests the fragile US Iran peace. Like I said earlier, the LNG carrier was struck by a projectile missile, and the oil rose up by 1%. This impacts India because India roughly imports 85% of its crude oil needs, and and a meaningful share move through the Strait of Hormuz. And every dollar move in the crude oil affects India's import bill, the rupee, the inflation, and by extension RBI policy and corporate input costs. IT stocks led the market into earnings season. Nifty IT was standout sectoral performance over the past two sessions, rising more than 3% at one point on Tuesday, with Infosys, HCL Technologies, Tech Mahindra, TCS, and all posting single session gains ahead of the formal Q1 earnings season. Here, the key would be to watch the management commentary, not just the headline revenue and profit numbers, when results start flowing in over the coming weeks. RBI holds the repo rate at 5.25%. The governor Sanjay Malhotra explicitly flagged that persistently elevated energy prices due to the West Asia conflict, along with the potential El Nino linked weather risks, pose an upside risk to inflation. Meaning the central bank wants to see how the geopolitical and the monsoon picture evolves before committing to another rate cut. So it's more of a wait and watch strategy. SEBI opens another major development is that SEBI reopens its door to stock exchange buybacks. SEBI approved amendments reintroducing open market share buybacks conducted directly through the stock exchanges, effective August 1st, 2026, alongside with existing tender offer and book building routes. But there's another development is companies using these routes must complete the buyback by 66 working days, with at least 40% of the earmarked amount utilized in the first half of that period. So a buyback is when a company purchases its own shares from the open market, reducing the number of shares outstanding. This can support the share prices and signal strong management's confidence. Though it isn't automatically bullish, it depends on how and why a company is doing it and what valuation. Next highlight would be India's GST collections post fastest growth in about 13 months. India's gross GST collection in June 2026 came approximately at 1.95 lakh crore, up 13.9% year on year, the fastest growth in the 13 months, and the second highest non-April collection on record. Mm, the headline was driven overwhelmingly by imports. GST collected on imports surged 34.6% to about 60,038 crores, while purely domestic collections grew at a steadier 6.5%. This suggests that the acceleration reflects a strong trade and port activity as much as pure domestic consumption strength. And GST collections are one of the best real time proxies for economic activity available to investors. They capture consumption, trade, and formalization of the economy in a single month number. Broad based collections generally support the government's fiscal position, funding capital expenditure without excessive borrowing. And let's look at the macro picture. US equities closed higher on Tuesday. S&P 500 was plus 0.72%, Nasdaq at 1.12% positive, Dow was at 0.3% positive, and Europe had more of a mixed reaction, with FTSE at minus 0.026%, DAX at positive of 0.15%. Asia was weaker on Hormuz linked energy sensitivity, with Nikkei at minus 2%, Shanghai at 1.1% negative. And gold seemed to be steadier. Silver eased by 1%, and Brent crude oil rose to 72.6 per barrel dollars per barrel. 10 companies that mattered this week. Infosys, it sharply rose nearly 4% in a single session. And why this matters is because the second largest IT service company in India, and it's a Nifty heavyweight, and before the earnings seasons, so it's something to be looked at and kept an eye on. Even Tata TCS gained alongside the broader IT rally. Why it matters is the largest IT company by market value, and typically the first major IT bellwether to report each quarter. TCS commentary on discretionary technical spending sets a tone for the whole sector's earnings season. HCL Technologies next, as one of the strongest gainers in the IT pack. Why it matters is diversified mix of services and products makes its commentary on both IT services demand and enterprise software trends a useful cross check on the sector narrative. Tech Mahindra is another top gainer. Trent fell over 11% after below expectations standalone revenue growth update. Titan Company rose after a robust business update, citing strong jewelry sales, store expansion, and international growth. Bajaj Finance drew positive broker commentary after Q1 updated showed assets under management up to 24% year on year and to roughly upon 5.46 lakh crore, with new loans up to 20%. And ONGC gained about 2.5% after a brokerage upgrade. Tata Steel capital expenditure around 20,000 crore, roughly 38% higher than the prior year, with about 60% embarked for Indian operations. And let's look at the sector radar. Banking has remained stable, watching credit growth and asset quality in Q1 results. IT rally leader into earnings season. Client budget commentary is swing factor. Auto positive undertone. April retail sales were highest ever for that month. Capital goods supported by strong government capex and IIP capital goods growth. Defense structural policy tailwind distinct for short-term geopolitical sentiments. FMCG mixed, defensive, watch input costs tied to oil and logistics. Pharma steady, benefits of dollar denominated exports amid dollar strength. Energy indirect focus from Hormuz incident. ONGC is in the spotlight. Real estate most rate sensitive sector, watching for further RBI easing rate cuts. And financial services strong credit growth signals. after Bajaj Finance got that plus 24% in the AUM growth. So definitely three things to highlights to watch for today is the Fed meeting, minutes being released, any developments in the Strait of Hormuz incident, and GIFT Nifty and uh, any early market cues. Given GIFT Nifty indicating a cautious roughly 0.7-0.8% weaker open for Indian equities today. Worth watching whether the caution holds through the session or fades as local data and specific stories take over. That's it for today. Thank you for joining, and have a wonderful trading day.